There's nothing quite like opening your mailbox and finding a letter from the IRS saying that there may be a problem with your tax return. If that letter is a CP2000, take a deep breath. While it's definitely something you need to address, it does not automatically mean you're being audited, and it doesn't necessarily mean that IRS is right. One question we hear all the time is, the IRS says I owe more tax. Doesn't that mean I made a mistake? Not necessarily. The CP2000 is simply the IRS telling you that the information on your tax return doesn't match the information it received from employers, banks, brokerage firms, payment processors, or other third parties. It's proposing a change based on that mismatch, not making a final determination. So what usually triggers a CP2000? In many cases, it's because income reported on a W-2, 1099, K-1, or brokerage statement wasn't reported correctly on the return. Sometimes a tax form arrives after the return's already been filed. Other times it's nothing more than a data entry error. And every once in a while, the IRS itself is working with incomplete or inaccurate information. Imagine you sold several stocks during the year. Your brokerage company reports those sales to the IRS, but your tax return includes some of the transactions. The IRS computer notices the difference and generates a CP2000 proposing additional tax. The problem is that the IRS often doesn't have your cost basis. Without it, the system may assume every dollar of the sale is taxable, making the proposed balance much higher than it actually should be. We see something similar with freelance income. Let's say you completed a side project and received a Form 1099 NEC. Since the IRS receives a copy of that same form, it notices that the income wasn't included and sends a CP2000 proposing additional tax along with any penalties and interest. One mistake people make is immediately paying whatever amount appears on the notice. Before you send a check, take the time to review everything carefully. A CP2000 is only a proposed adjustment. Sometimes the IRS is completely correct, sometimes it's partially correct, and sometimes it's based on missing information that changes the outcome entirely. The most important thing is to pay attention to the response deadline. In most cases, you'll have about 30 days to respond. If you agree with the proposed changes, you can sign the response, arrange payment if necessary. If you disagree, you'll want to respond before that deadline with the documentation supporting your position. Ignoring the notice simply allows the IRS to move forward with the proposed assessment. Another point that's worth clearing up is the difference between a CP2000 and an audit. Although both involve the IRS reviewing information, a CP2000 is generally an automated matching process. It's much narrower in scope than a traditional audit and is often resolved by exchanging information through the mail. We also encourage taxpayers to hold on to their supporting tax records after filing. Brokerage statements, corrected Form 1099s, documentation showing your stock basis, and records supporting deductions or business expenses can make all the difference when responding to a notice like this. Having those documents readily available often makes the process much smoother. So here's the bottom line. The CP2000 isn't the IRS telling you that you definitely owe more tax. It's the IRS saying, our records don't match yours. Can you help us sort this out? So taking the time to review the notice carefully and respond with the complete information can save you both paying taxes, penalties, and interest that you may not actually owe. Have you ever received a notice from the IRS that turned out to be based on missing or incomplete information? Let us know in the comments. We'd love to hear which IRS notices and tax topics you'd like us to cover next. If you found this helpful, please like and subscribe for more practical tax accounting and financial insights. And if you've received a CP2000, don't assume the IRS is right or automatically wrong. Reviewing the notice with your tax advisor before the response deadline can help you understand exactly what's being proposed and determine the best way to respond.